The FIFA World Cup just kicked off in the United States for the first time in 32 years. 48 teams, 104 matches, 16 host cities stretching from Los Angeles to Boston. FIFA projects $17 billion in US GDP impact, with 6.5 million attendees and 2.6 million international visitors, each spending an average of $5,000 over a 1-2-day stay. It's only human nature that every major brand on the planet has bought in, and the sponsorship money alone is staggering. Yet, the most obvious stock play, Nike, which sponsors 12 teams, including Team USA, just had its analyst estimates slashed. Bernstein called the World Cup turnaround hype overblown and cut its revenue growth forecast for the tournament to low to mid single digits. The biggest sporting event in history is happening on American soil, and the stock every retail investor is reaching for may be the wrong one. My name is Phoebe, and you're watching Trading Key. The invisible World Cup winner, Meta and Google. Most coverage of the World Cup trade focuses on the obvious: Nike, Fox, the official sponsors. The angle that gets missed is the one with the cleanest margin profile. The 2026 World Cup is projected to generate $5 billion in incremental global advertising spend across the tournament. Roughly 73% of that flows through digital channels, which puts $3.65 billion landing on Meta and Google's ad platforms, largely automatically, as brands around the world compete for eyeballs during the most watched sporting event on Earth. To understand the scale, let's look at what happened during the 2022 World Cup final. Google search recorded its highest queries per second in its 5-year history. Not its highest for a sporting event, its highest ever, period. Meta's platforms saw similar spikes as billions of people shared clips, debated results, and tracked scores across Instagram and WhatsApp simultaneously. As for what's changed since 2022, Meta's AI-powered ad recommendation system has materially improved click-through rates and conversion efficiency. And Alphabet's search AI overviews are expanding query volume. Both businesses are structurally better at converting attention into revenue than they were 4 years ago. The same viewership spike that hit in 2022 will hit again in 2026 through platforms that now monetize that attention more efficiently. The cleanest trade here is margin. Meta and Google don't need to sponsor a team, produce a broadcast, or build a stadium. They provide the infrastructure that brands use to reach fans, and they take a cut of every dollar spent doing it. No production costs, no rights fees, no inventory risk. Pure operating leverage on an event they had no hand in creating. DraftKings' biggest event in history, even bigger than the Super Bowl. Now, DraftKings is the trade most people are sleeping on. Global wagers on the 2026 World Cup are estimated at $50 billion across the tournament's 104 matches. Truist analysts ran the numbers specifically for the US market and arrived at $1 billion handle opportunity for DraftKings alone. To put that in context, the Super Bowl, the single most wagered event in American sports history, generates roughly $900 million in handle. The World Cup surpasses it. And unlike the Super Bowl, which is one game over one afternoon, the World Cup runs for 6 weeks. Group stage, round of 16, quarterfinals, semifinals, and final. 6 weeks of daily betting volume, live in-game wagering, player props, and same-game parlays. What makes this World Cup different from every previous one for US investors is timing. When Qatar hosted in 2022, legal sports betting was available in only a handful of US states. Today, 38 states have legalized it. DraftKings and FanDuel together control roughly 80% of that market. The same $50 billion in global wagers is now flowing through platforms that simply did not exist at scale the last time the US audience had a home team to bet on in a World Cup on home soil. So DraftKings guided full year 2026 revenue at $6.5 to $6.9 billion, with adjusted EBITDA of $700 to $900 million. The World Cup handle landing in Q2 and Q3 is a meaningful catalyst within that guidance range, and Truist's billion-dollar estimate is widely considered conservative, given the expanded legal betting footprint. Why everyone gets the apparel trade wrong. Nike is the instinctive World Cup apparel play. It sponsors 12 national teams, including Team USA, Canada, and England. It has the marketing budget, the retail presence, and the brand recognition. In the week the tournament was announced as US hosted, retail searches for Nike World Cup jerseys spiked. But Bernstein's June analysis told a different story. Low to mid single-digit sales uplift from the World Cup, not enough to move the needle for a company doing $50 billion in annual revenue. And critically, that uplift lands against a backdrop of structural challenges that the World Cup cannot fix. Nike is losing market share in running to On Running and New Balance. Its China revenue is declining. Gross margins are under pressure from elevated promotional spending. The World Cup is an event that generates excitement about football, not a restructuring plan. On the other hand, Adidas is the trade that is actually working. It sponsors 14 national teams, including Germany, Argentina, Spain, and Japan. It has supplied the official match ball at every World Cup since 1970, meaning its logo appears at the center of every kickoff, every free kick, and every goal, regardless of which team scores. Adidas reported 250 million euros in World Cup-related orders in Q1 2026 alone, with a similar amount expected in Q2. Its stock has risen 19% in the past month, while Nike has moved roughly 4%. And so it seems the order book is already confirmed. The revenue is already coming in. Nike is the headline, while Adidas is the trade. With apparel trades around sporting events, look for the company with confirmed order flow, not projected marketing uplift. Adidas has the former, Nike has the latter. The broadcast play and the long game bet. Fox Corporation holds the US English language broadcast rights for the 2026 World Cup. Analysts project approximately $550 million in advertising revenue from the tournament, with 70 matches airing on the free-to-air Fox network in prime time. That is a significant revenue event for Fox, which generated roughly $14 billion in total revenue last fiscal year, adding roughly 4% to annual revenue in a single summer with minimal incremental cost since the rights were negotiated years in advance. The stock moved on the rights announcement, and smart investors have been positioned since the bracket was drawn. If you're buying Fox for the World Cup today, you are arriving late. The more interesting position is Apple, and the angle has nothing to do with the World Cup broadcast itself. Now, Apple doesn't hold World Cup streaming rights. What it holds is a $2.5 billion decade-long MLS streaming deal that gives it exclusive rights to every Major League Soccer match until 2032. MLS viewership on Apple TV is already up 62% in 2026. The World Cup hosted in the United States is the single most powerful catalyst imaginable for the growth of soccer in America. Every neutral fan who watches the U.S. men's team advance through the bracket, every kid who picks up a ball because of what they saw on television, is a potential MLS subscriber in the years ahead. This isn't a 6-week trade, but a structural bet on soccer becoming a mainstream American sport, and Apple has already paid for the position. The tournament validates it, but the returns compound over a decade. The World Cup investor playbook: what to buy, skip, and watch. All right, let's recap. Meta and Alphabet are the cleanest short-term trades. 6 weeks of digital ad spend windfall, no operational exposure, pure margin leverage on an event that drives the highest search and social engagement volumes the internet generates. If you own either stock already, the World Cup is a tailwind. If you're looking for a near-term entry point, the tournament runs through mid-July. DraftKings is the highest upside event trade, a $1 billion handle window that Truist considers conservative, spread across 6 weeks rather than one game. The risk is execution, whether the platform handles the volume, and whether U.S. consumers engage with soccer betting at the rates the industry is projecting. Adidas is the apparel trade, not Nike. The order book is real, the stock is already moving, and the match ball logo is on every piece of footage the world will watch for the next 6 weeks. Fox has the rights, but the trade is largely done. Apple is the long game, a decade-long position on American soccer growth, validated by the largest tournament ever hosted on U.S. soil. So, which World Cup stock are you most interested in? Meta and Google for the ad windfall, DraftKings for the betting boom, or Adidas for the apparel trade? Let me know in the comments below. Thanks for joining me today. If you found this video helpful, remember to subscribe to Trading Key. Give this video a like and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.